Assalamu alaikum, I'm Carl Arrindell and you're watching In Focus. Last weekend, as Europe and North America slept on Sunday night, Chinese markets went through the floor. The Shanghai Composite Index of Stocks fell by 8.49%, the biggest single-day collapse since 2007. It wasn't alone. Hong Kong's Hang Seng fell by 5.17%, Japan's Nikkei fell 4.61%. Stocks in Taiwan, the Philippines, Singapore and Thailand also tumbled. And when European markets opened a few hours later, it was a similar story. Every stock index in Europe experienced an historic collapse. The Euro Stoxx 600 fell by as much as 7% and the FTSE 100 by more than 5%. Remarkably, in the days that followed, global stock markets experienced a surge, recovering most of the losses that they had suffered on Monday's crash, after the Chinese authorities apparently bought shares to prop up their prices, and figures illustrated by the US that US growth was surging ahead. To help us understand the significance, the cause, the implications of Black Monday as it was branded, I'm delighted to be joined today by Adam Ismail Ebrahim, the Chief Executive Officer of the renowned and much celebrated UK-based Oasis Crescent. Oasis Crescent is the holdings company of a collection of multiple award-winning wealth management companies specialising in investment management and wealth creation. Crucially, they are the world's leading providers of financial products designed to meet the specific needs of socially responsible investors, including Sharia compliance. Assalamu alaikum, Adam, and welcome to In Focus.
Wa alaikum salam, Carl. Always a great pleasure to speak to you.
Now, Arthur James Swan, in his book, How Unregulated Capital Caused the Crash of 2008, edited and revised, I will add, by David Pidcock, now Dowd Pidcock, a former Bank of England executive who has become an advocate of Sharia finance. They made the claim that the nature of the system, unchecked, unregulated capital, posed, and I'm quoting them, the gravest threat to our freedoms, adding that this was not only responsible for the crash of 2008, but has been the cause of every economic catastrophe since the Bank of England was founded in 1694. President Obama, in his State of the Union speech last year, made the statement that the House of Cards had finally collapsed. Was Arthur Swan correct? Is regulation the cause of last week's crash?
Regulation's not the cause of anything. It's bad human behavior, it is bad politics, and it's bad business that causes surges and collapses. However, if you look at financial markets, they don't always go up in a straight line, and they don't always go down in a straight line, but over time, over 50 years, they actually go up, but there's up peaks and valleys. And what happens is when things are going up, everybody celebrates growth and they become greedy and they don't actually understand that they may actually be overpaying for something. And then when they do overpay for it because they go and borrow money to invest in the stock market and they don't actually understand that they're doing it for the long term, and it's greed driving them. And when the markets move down, they actually blame regulation rather than their own bad behavior and their own greed. And then when the markets are right at the bottom, they're so fearful when things are really cheap. So just take something, if something's worth £1, because of greed it goes up, they're prepared to pay £20. And then when it comes back to the pound, which is, it's only always been worth £1, they actually get fearful. And then it goes to 50p. And that's when it's fantastic to buy because you're going to make 100% return on your investment. And over time, that pound will grow by a certain natural growth rate. And we'll talk about that in a minute. But it's not regulation, it's greed.
Or rather lack of regulation. Because look, Arthur Swan spent his entire life campaigning for greater regulation. He said this was the cause of all evil, the lack of regulation. Now, we can understand people's natural tendencies to be greedy or to, and that's a whole issue of itself, to try and manage those expectancies and those levels of greed. But is it the case that there ought to be much more fixed regulation on all these things, or do you think that's a problem in itself?
I think there are two elements to it. Islamic finance is basically a couple of things, based on a couple of items, which is very different to conventional finance. The first is we frown on speculation. We frown on debt. And so if you look at Islamic finance, you don't allow derivative instruments. You don't allow people to use $1 and invest $1,000 with the hope that they're going to make money, and so they hope that the $1 becomes 100 and they're going to pay off the 1,000. We don't allow that. And so if speculation is not allowed, it reduces the volatility. And so Islamic finance is inherently less risky and less volatile. And so over time, as more and more companies follow the path of Islamic finance and ethical finance, and it's not only Islamic finance, because many other ethical based financial systems and methodologies frown on these things, and therefore you get a less volatile, and then the greed and fear, because you're not speculating, you're actually investing. So Islamic finance is about investing, and the real issue is conventional finance includes speculation.
But that raises the question, and it underlines a constant debate, which is that policymakers are being charged consistently with having only a very few tools to respond to such crashes as we saw last week. The apparent panacea, quantitative easing, was hailed as the answer to the crash in 2008, but many have argued that it penalised investors at the benefit of debtors, and you mentioned debt a few minutes ago. Would you agree with that?
We agree with it from one perspective. We believe that if you're going to have this normal economics, then yes, policymakers need to play a role, but the law of the jungle needs to work, okay? And the law of the jungle, whether we like it or not, the weak have to fall, the weak corporates have to fall. And just think about it, if you have 10 players, one very uncompetitive or two very uncompetitive, and they actually shouldn't be around. So when economies turn down, those players should go out, and the stronger players who have continued to invest will pick up that market share. Their factories will get full. They will start employing. They will start investing. And that is normal economics. What quantitative easing does is it actually makes it easier for the weak to stay in. And so the strong, or the rest of it, who have the ability, they're efficient, they're effective, they can employ and they can invest, are unable to do that because supplies remain too high. So we think that quantitative easing has actually been bad because it's kept supply higher than normal, because cost of capital has been too low. It's subsidized the cost of capital. And therefore, we're taking a very, very, very long time. We're spreading the pain over a long time, and we're creating more supply. And unfortunately, whether you like it or not, the weak have to fall.
So you'd rather see companies going to the wall that were just not up to it?
Yes, because the companies that are innovative, who are great, who have great employment practices, who employ lots of people, are now being penalized, and the weak and the ineffective and the inefficient organizations are being kept alive. That's unnatural. And so we're not creating the employment that we would normally have created because we're keeping the weak in. You cannot have a system that says that, oh, by the way, if I'm bad, I'm protected. And that's what quantitative easing is doing. If you're bad, you need to be moved out.
Culled.
You need to be. That keeps that's nature. That keeps going back to just the law of nature. Going back to the jungle. If you don't, that's just how it works.
Now, going back to the crash of last week, how did it impact on the global economy? We saw a historic decline overnight across the world. How did it affect investors, ordinary savers and borrowers?
I'm going to put it in two categories. It affected everybody in the short term, okay? But it only affected speculators permanently. And long-term investors, it was not going to affect it. It's not going to affect them. So those people, so Islamic finance, remember Islamic finance we said was about the long term, was about sustainability and matching people's investment horizons. So if you have a 1-year horizon because you need the money to pay your electricity and buy food, you cannot put the money into certain products. If you have 5-year time horizon that you need the money in 5 years' time, you cannot invest in certain products. There's a different product range. And if you have a 10, 20, 30-year time horizon, because you're saving for retirement, you're saving for pilgrimage, all of those long-term items, then the other products. So just, you know, you said it earlier on, the decline of Monday, Tuesday, it's all been recovered Wednesday, Thursday, Friday. Now, if you went to sleep and you woke up and you'd not have noticed anything, and yet there was pandemonium, and the pandemonium caused the speculators who were using borrowed money and were using derivatives, they lost. And the people with greed or fear, they are penalized, and the speculators. Yet long-term investors, we were sharpening our pencils, we were getting ready because we saw things that were worth £1 or $1 going down to 60, 70.
Well, talking about you sharpening your pencils, Adam, this leads me, obviously you're a key advocate on Sharia principles, ethical investment. You've talked about investment rather than speculation. How did Oasis's management of funds do during this period?
Okay. Those are, you know, you're looking at the short term. Let's look at, I'm going to start with our first fund, our first Sharia compliant, our first ethical fund. It was the first fund that we've ever launched. We launched that fund in 1998, the Asian crisis. And I started my career going back further, the true Black Monday, 1998. And the market actually declined 19%. And if you look at the long term, you can actually see that blip. Okay? But it was, for that one day, it was dreadful in that short period. But on a 20, 30, 40-year period, it's insignificant. So when you look over the long term, the Crescent Fund started, the Oasis Crescent Fund started in 1998, Asian crisis. Then 2000, the tech bubble. 2001, the US crisis. Okay? And so on and so on. In between, we had the South American crisis, the Russian crisis. Then we came to 2008, the American crisis and European crisis, financial crisis. Okay? And by the way, if you had invested $1 million on the beginning of that period, over to end of July, you know, that fund would have, that $1 million would have been worth 24,
so
25.
Are we saying then that investors in your management funds didn't even get close to having a cold, not even a cough?
No, just a second. They shouldn't have, because we're not encouraging speculation. So yes, when the markets are down, we'll go down, but we'll go down 70, 80%. But we're not buying or selling. We most probably, when the markets are down, we're buying. Okay? And the next day it was all up again. Okay? And when the markets are very high, we're selling. So this is part of what we do. This is part of our DNA. This is part of our trade. And you're actually paying us to be analytical, have a long-term focus, and add value by taking advantage of these anomalies. And these anomalies are, we really on the other side of speculators. When they are being prepared to pay way above what something is worth, we'll sell it to them.
So tell me, this crash, crash that started from China, was it to be compared to the crash in 2008, the one that saw the collapse of the Lehman Brothers Bank?
Yes and no. Maybe 5% yes and 95% no. And the Lehman crash was built over many, many, many years of exuberance and of bad practices and of poor regulation and of, people forgot 1997 and many of the other stock market declines. And there was the amount of debt and poor operating procedures in the financial system was very high. When you look at the current situation, the one area, there's two elements to it. The one area is that places like China, to grow the economy faster than what they should normally grow it, they encourage speculation.